Hello there. I hope that you're doing well. Welcome to the third episode of the Swing Trading series here for the 2025 mentorship. I hope that you watched the first two episodes before watching this episode. I understand that some of you will go backwards through this series and you will begin at the end and go back all the way to the beginning, but I truly suggest you to begin this series from episode 1 and move onward from there. The reason why is because I'm sharing everything during this lecture to someone who has already watched through those first two episodes, so please do so. Navigating the weekly delivery. Each week requires a different approach as swing traders. This has to do with the difference when it comes to each weekly economic calendar. Meaning, we use the economic calendar as our roadmap. Based upon the economic calendar, we can anticipate when and where volatility will get injected into the markets. As swing traders, our job is to capitalize on these volatility injections, which cause the markets to expand. Understanding weekly delivery profiles is therefore crucial. Before you are watching this swing trading series, I already suggested you to begin with the predicting price series, and I'm going to suggest that again. If you did not watch the weekly profiles episode yet within the 2024 mentorship playlist, I would highly suggest you to watch the second episode of that predicting price series on weekly profiles. In that episode, I share everything you need to know when it comes to understanding how to use the economic calendar properly. During this episode, I will expand on the knowledge provided. General rules when it comes to navigating the weekly delivery. Your focus should be on recognizing the higher time frame institutional order flow by paying attention to the reactions to previous week's high or previous week's low and the previous month's high and previous week's low. These are our most important time-based liquidity pools, which we can monitor the reactions of to see how IPDA is currently delivering price. If the higher time frame order flow is clear, we can enter swing positions early in the week in advance of the high impact news scheduled for that week. If the higher time frame order flow is however not clear, we need to wait for the high impact news to deliver before holding on to one-sided biases for the week to come. Why would we have to wait for that high impact news to deliver before we can hold on to a one-sided bias if the order flow is not clear? Because the news is likely going to manipulate then, and what always follows after manipulation? After manipulation, distribution will always follow, and the news will function as a volatility injection so that manipulation can occur so that we can then distribute our positions afterwards. Now notice that these are if this, then that statements. And that is something which is very important to understand, since this is how we are objectifying our approach to the markets. Where the majority of traders are reacting to price, we are absolutely anticipating how the markets will deliver. And that's the result of us utilizing these if this, then that statements. If the higher time frame institutional order flow is clear, we can look to enter in advance of news. If it isn't clear, wait for the news. That right there is part of the navigation of the weekly profile. And even if you're not a swing trader, this is a rule which should be applied to your own protocol when it comes to navigating higher time frame institutional order flow. Implementing time as swing traders. Use the economic calendar to anticipate when key price swings will occur. Meaning, based upon the economic calendar, we can anticipate when major volatility injections will take place. If the higher time frame institutional order flow is already in, and we can see what the markets are likely going to do next, news is likely going to get utilized for the markets to draw towards our objectives, meaning news will be utilized as an expansion tool. Use the London and New York AM session to look for setups, meaning the majority of the setups which we are going to look for as swing traders that are focused on capturing intra-week volatility. We are focused on participating in the markets during either the London or the New York morning session. And that has to do with the fact that we can utilize the midnight opening price as a key reference point throughout the daily delivery. Sorts of high impact news. Regular high impact news are the following. Any high impact news driver besides NFP, CPI, FOMC or other big worldwide events is considered as regular high impact news to me. Next to that, we have the big three. The big three consists of NFP, CPI, and FOMC. These are the two classifications of high impact news that I look for. And these two classifications of high impact news require different protocols. And let me explain. Navigating all weeks when there's clear order flow has the same protocol. And that is when the new week opens up, our focus is drawn to the delivery between the new week open and the high impact news, which is already scheduled in advance. The eye therefore represents where we are looking to position ourselves. Our eye is open for opportunities, so to say. This is the framework which applies to navigating all weeks, so both the regular high impact news weeks as the big three weeks. But keep in mind that this is only allowed when there is clear higher time frame institutional order flow. If the higher time frame institutional order flow is clear, focus on the days in advance of the high impact news. News will distribute. Keep in mind if the higher time frame institutional order flow is clear. Navigating regular weeks with no clear order flow. A regular week is again a week outside of the big three or any other big worldwide events. And therefore, when there's no clear order flow present in advance of this high impact news, we must anticipate that opportunities will present themselves after the high impact news. Therefore, you can see in this schematic that we have the new week open right here. We have the high impact news showcased by this red line right here. And we have the end of the week. Our focus is on monitoring how the high impact news will get utilized to inject volatility into the markets so that opportunities can present themselves after the high impact news before the end of the week. Do you notice the difference? This is a result of the higher time frame institutional order flow not being clear. So as a general rule of thumb, if the higher time frame institutional order flow is not clear, focus on days after the high impact news drivers. This is a keynote for your protocols because this shows you how to navigate the weekly profiles properly. Navigating the big three, NFP. When there's clear order flow present during an NFP week, our focus is on the following. Notice that NFP is always on Friday of this week. Therefore, you can see that it's right here near the end of this week. Our focus is on the following. Our focus is on the time between the new week open and the Wednesday's afternoon session. Meaning, we will be looking to position ourselves in advance of Wednesday's afternoon session. That means that our focus is on Monday until the end of Wednesday's morning session. If by Wednesday's end of morning session, no opportunity has presented itself yet to participate in the weekly delivery, as swing traders, we must wait until after NFP. Because NFP is likely going to inject major volatility then. If, however, clear order flow is already present from the moment that we open up the new week, we can look to establish a position in advance of the end of Wednesday's morning session, and then we can look to capitalize on the volatility which is likely going to follow throughout the remainder of the week with the NFP release. We're now going to be looking at navigating the big three and specifically CPI and FOMC. But keep in mind that now there's no clear order flow. Because there is no clear order flow established in advance of CPI and FOMC, we must wait until after the release of the event. And please note that I'm speaking about either CPI or FOMC. It can also be both, of course, but in this case, I'm speaking about either. Meaning it can either be CPI right here or it can be FOMC. Our focus is on after the event to look for positions to be established. This is a result of there no clear order flow being in place just yet. And therefore we need to wait for after the event before we can say, all right, this is what's likely going to happen next. Because the news release is likely going to be utilized for a major volatility injection, which is going to cause for distribution to follow afterwards. Let us pay attention to some chart examples. Here we're on the daily chart of Nasdaq. And what I want you to see is that Nasdaq expanded higher beautifully here. And you can see that a beautiful buy program was established. I'm going to walk you through this delivery. And I want you to pay attention to each of the annotations which I have. First of all, I want you to see this down close candle right here. The open of this down close candle was the open of the year of 23. Next to that, it was the open of the month of January. From the opening, you can see that the market dropped lower and took out sell side liquidity resting below this low. Why is this low important? Because it is the previous month's low. It's the low of December. Notice that the market took out this low and then expanded higher. Notice that an imbalance formed whilst the market traded above this yearly and monthly open. We can see that the market retraced into that BC, into that imbalance. We then saw the market expand higher. Inside of the retracement into this imbalance, there's already an opportunity to go long. And that's a result of IPDA already showing its hand to you by this displacement higher. If you would be focused on establishing positions that would last multiple weeks or even months, this would be a potential entry opportunity. But that is something which we'll discuss during the next episode of this swing trading series. What we can see is that the market expands higher and we see it trade above this retracement on the left side of the curve. As outlined prior, when the market trades above a previous range, which functioned as a retracement range, as you can see here, where we saw the market expand lower, retrace higher, expand lower. When we see the market expand above the high of that retracement range, we want to see it function as support on price. Notice that a retracement occurs inside of that range multiple times and the market expands away from it. Another retracement occurs and we then see the market displace higher and this imbalance forms right here. Notice how the market retraces into that imbalance and we again see it just step into it before expanding higher. What is the market drawn towards? The market is drawn towards buy side liquidity resting above this high. Why specifically this high, you might be wondering? Because this high was the high of December. Meaning, what we anticipate is that price is going from the previous month's low to the previous month's high. That's a purge and revert of a monthly low towards a monthly high. When we pay attention to Nasdaq and the ES then, I want you to investigate the delivery on the lows right here on both Nasdaq and ES. I want you to pause this lecture for a moment and I want you to try and see whether or not you can see anything of significance right here. Some of you never pause these episodes. It's pretty fun. You're missing out on this learning opportunity, guys. Don't waste it. So what I want you to see is the following. What I want you to see is that Nasdaq took out that December low, as you can see right here. A lower low formed. If you, however, pay attention to ES, you'll see that ES made higher lows. And that right there is SMT relative to a monthly low. And when you combine that with the understanding that we just opened up a new year and we initially dropped lower, that right there is a key algorithmic signature. We see the market displace higher above that opening price, and that right there is IPDA tipping its hand to you. Now, you might be wondering, how could we possibly use this information of the market being bullish and it being drawn towards the upside? Well, if you remember that slide in which I showcased to you where the market had those daily imbalances, we are now on the RE chart and I've plotted those daily imbalances, these blue shaded box, and I'm going to walk you through the delivery that has taken place from that blue box. What I want you to see is that you can see that the market consolidated right here. Notice that relatively equal lows formed. This right here is the original consolidation within a market maker sell model. The market expands towards the upside and we see it consolidate once more. Eventually the market runs the previous day high, the Monday high, and we see the market reject that high. A sudden drop lower takes place and notice that this CB gets created. We see a retracement into that CB occur and the market is now drawn towards these relatively equal lows. But please keep in mind that the sell program is only going to last until that higher time frame discount array gets reached of that daily BC. We see the market expand lower and throughout the New York morning session, listen closely, throughout the New York morning session, this daily BC gets reached. These relatively equal lows get purged and we see the market form a low there at exactly 10 a.m. right here. We see the market reverse from there and we begin to see the market draw towards the upside. Notice that when this repricing higher is taking place, we can see that the market displaces above this sequence of down close candles. This is very important to understand. The reason why is because this sequence of down close candles set up the run into the daily imbalance, into these relative weaker lows, and what is resting below these relative weaker lows? Sell side liquidity. And what's occurring is that smart money is being offered the opportunity to buy in a discount, utilizing all of those sell orders which are resting below these relative weaker lows to fill long orders so that the market is then allowed to expand higher. The moment that price traded above the open of this sequence of down close candles, it's a change in the state of delivery, and this is already a potential buying opportunity. Is it possible to go long inside the smart money reversal? Yes, it would be possible to go long inside the smart money reversal with a wide enough stop loss, which would allow for the market to trade deeper into the daily imbalance. But that's a topic for another time, because then the position which we would be looking to establish would be more of a, I would say, longer term position. Then we would try to hold on to that position for weeks or maybe even months, since that is a higher time frame swing which is being established. As a intra-week trader, this would be the first entry opportunity in my opinion when the market trades above the sequence of down close candles, because this is your change in the state of delivery, and now we can logically anticipate that we're likely going to see the market draw towards buy side liquidity resting above this high, and next to that, buy side liquidity resting above this high right here, which is of course that December high. Now notice when the market reprices above that CB which formed on Tuesday, you can see that that CB functions as support on price. This right here is an inversion for value gap. Pay attention to this retracement leg on the sell side of the curve. That retracement leg has to function as support on price, as you know. We see the market expand above the Tuesday high, and we see a retracement taking place afterwards. Notice that new buy side liquidity is being engineered, and the market eventually retraces before continuing higher. Every single time that price is taking out a key buy side liquidity pool, as you can see right here, and it then retraces, it's engineering new buy side liquidity. And that's the same fractal which you're seeing right here. And this is key information which you need to understand. This is how the markets are being utilized to engineer liquidity, which we can later use to our own purpose, as you know. Now, when we pay attention to what occurs right here, you can see that the market stops right in advance of that December high right here on the end of the week on Friday. That right there is very suspicious, and let me explain. If we are ending the week right in advance of a higher time frame drawing liquidity, what does that mean for the week to come? That we are likely going to see the new week open low. Listen closely, teaching opening logic to you. That we're likely going to see the market open low and begin to draw towards the buy side liquidity engineered above the previous week's high and that longer term buy side liquidity objective of that December high. When we pay attention to the delivery which occurred, you can see that the previous week's high was engineered in advance of the higher time frame drawing liquidity of the December high. This is very important to know because this shows you how liquidity is constantly being engineered and how true manipulation is taking place. We see the market expand towards the downside, and this is the sell side of the curve which is being established. Notice what the market is being repriced back into. It's being repriced back into that old CB's price range, as you can see right here. Notice that we see the market tap into that CB's range, into that inversion to value gaps range, form a low there, and then begin to displace higher. We displace above this opco candle. Why is this opco candle in particular so important? Because this opco candle formed inside of this CB right here, as you can see. And next to that, this high set up the final run lower into that old inversion for value gap. Therefore, you need to understand that the moment the price closes so aggressively above that opco candle, this is a bullish breaker. Why? Because we say low, high, lower, low, high, high. During this week, we had FOMC and NFP on Friday. Therefore, as outlined prior, when the higher time from institutional order flow is so clear to us, and we anticipate that we're likely going to see the market expand higher, we can look to position ourselves long in advance of all of that high impact news early on in the week, because we can anticipate that the news is likely going to get used to distribute. We see the market retrace into this opco candle, and this is your low risk buy within a market maker buy model, with our original consolidation being up here, with the previous week's high being the drawing liquidity. breakaway gap gets created and the market expands higher. On Wednesday, FOMC release is scheduled and there's a lot of high impact news during the morning session, such as the JOLTS job openings, which is also a high impact news driver, as you know, which is very important to note. Consolidation is occurring, and eventually what we can see is that the market opens low during the afternoon session at 2 p.m. when the FOMC release begins, and we see the market expand higher, beautifully towards our drawing liquidity, and that's the delivery done. Guys, do you see the power of understanding when news is likely going to take place, what the drawing liquidity is, because you can literally anticipate when they're going to reprice towards that drawing liquidity. How beautiful is that to understand? Now, let us move on to the next example. The next example which we're going to discuss is a swing trading opportunity on both Euro, SGU, as you can see right here. On the left, you can see the Euro daily chart, and on the right, you can see the GU daily chart. Now, what I want you to see first of all is the following. What I want you to see is that from the yearly open on Euro, we saw the market initially run up higher, form this swing high, and then we saw the market displace lower. Notice how a CB forms through the yearly open. Remember what I outlined on the daily chart of Nasdaq and ES. We see the market eventually expand lower, and it then begins to retrace. Notice that we retrace above the open of the month of February, which is right here, and we retrace back into this daily CB right here. Now, the reason why this is so important to note is due to the following. Whilst Euro is making lower highs, at the same time, you can see that GU is making higher highs this whole time. I have annotated exactly the same time-based high, which you can see right here, and you can clearly see that on GU, higher highs are being made, whilst on Euro, lower highs are being made. This by itself is SMT, and it shows to you that when a second SMT is going to take place, we are likely going to form a swing high from a key level so that we can anticipate lower repricings to take place soon. What is the key level that we're monitoring? Yearly open right here, and this CB. Notice that Euro makes a higher high with this long wick, whilst GU makes a lower high right here. That right there is SMT between these daily candles. We see the market displays lower, and we see a CB form. Through what does this CB form? Through the February open. And guys, like, start paying attention to opening prices and erase that form around them. That's something which you need to take away from this episode, even if you're not a swing trader, because the same logic applies to lower time frame trading as well. Notice that there's very large CB forms right here, and we see the market retrace into that. IOFET, institutional order flow entry drill, is taking place from this CB, and the market expands lower, drawing towards sell side liquidity resting below this low, the low which set up the retracement, and sell side liquidity resting below this low. Now, what we will do is we will pay attention to the delivery inside of this CB. So what I just outlined to you is how from the daily chart, you can tell that the order flow is bearish, where you can see that premium rates are functioning as resistance on price, and there's SMT with a highly correlated market. Now, we have a higher time frame array right here of a daily CB, which displays through the February open, after we saw multiple SMTs confirming that the underlying order flow is in fact bearish. Here on the hourly chart of Euro. And what I want you to see is the following. What I want you to see is that this candle's high is the low of that daily CB. Notice that the market consolidated right here, and we then saw it expand lower on Monday. The function of this expansion lower on Monday is to trap retail-minded traders into thinking and believing that we have already formed a high of week and that Euro is very bearish. They will look to go short throughout this expansion lower and place their stop losses above these highs right here. We see then on Tuesday that the market initially drops lower from the midnight open right here. We see the market then expand higher. Notice how a BC forms right here. Midnight open, BC. Little jump for you in there. Market retraces into that BC, institutional order flow entry drill, and we see an expansion higher taking place. Now, here comes something which I absolutely love to see. And that is that the market stops right in advance of that daily CB, that blue shaded box. Notice how the market begins to consolidate. Again, what is occurring here? Liquidity is being engineered in advance of that point of interest, in advance of that higher time frame array. Now, what we're looking for is looking for the market to open high into that at the right time so that we can anticipate that we're likely going to see a reversal taking place. What I want you to see is that inside of this week, on Friday, we have the NFP release. We are now on Wednesday. When is the final time that we can look to enter our positions? By the end of Wednesday's morning session. And therefore, this is still within our time of interest for this week. Notice that the market forms a swing high inside of that daily CB. We see the market displace lower. We displace with a CB through the weekly open right here on the RE chart. We displace below this candle's low. Why is this candle's low important? Because this candle's low formed inside of this BC right here. And you can see that this low set up the final run higher, taking out buy-side liquidity resting above this high. You see the market retrace into that candle's low, and this is where we would look to go short. We are shorting above the weekly open, as you can see, inside of a premium array of that CB, inside of a bearish breaker, inside of a market structure shift pattern low, and we know that the higher time from institutional order flow is bearish, with NFP being on Friday. How many confirmations do we need? How many confirmations do you need that this is the low risk sell within this market maker sell model fractal, with this being the buy side of the curve and this being the sell side of the curve? Accumulation, manipulation, distribution. On Thursday, the market begins to slowly grind towards the downside before the real expansion lower begins, which continues on Friday, where the market is just drawn towards higher time frame sell side liquidity pool objectives. With that, this third episode of the Swing Trading series comes to an end. I hope that this episode and the previous episode has given you a good insight in how to navigate the markets as an intra-week trader, where we look to capitalize on weekly volatility. During the next episode, I will teach you how to look at more longer-term trading moves, where you can look for entries that will last for multiple weeks or maybe even months. This is, of course, a larger swing trading perspective. I want to wish you all the best, and I kindly suggest you and recommend you to investigate all of these signatures which I've taught to you. I look forward to speaking to you in the next episode. Be safe.